Joining us now, Nili Gibert, who chairs the David Rockefeller Fund Investment Committee, is also co-founder of the Net Zero Plus Investment Collaborative. Nili, it's great to see you. Before we dive into Net Zero Plus portfolios, just wanted to get your take on the broader market here. The fact that we're looking at the worst week in a few months. We've had this retail trading frenzy. Does it make you question valuations and the overall stability of this market?
Well, thank you so much for having me back on the show. It's great to be here. 2 points to make about the markets right now. One tactical, one strategic. From a tactical perspective, I'm still positive on the stock markets. But, before this pullback, it looked like they were getting pretty frothy. A lot of positive sentiment. The fact that this is the biggest pullback we've had in months when the market's not even down 2% right now. It's healthy for us to sometimes have corrections and to remember that markets can go up and down. So I'm actually even more positive as we pull back here than I was just before. But the strategic point is really longer term. And this is about ESG materiality, and particularly social materiality. Years ago, when economists would talk about income inequality affecting the economy, it was kind of theoretical. But now we're starting to see how social issues really can affect our economy and our markets in serious ways.
I want to talk about how you invest around that. But first, Nili, you did say that you're seeing areas that looked very frothy and that looked ripe for a correction. One of those areas could be places in ESG world. EV SPACs, for instance, have become a hot craze. Did any of those areas that you're looking at in some of your climate initiatives get bubblicious?
I'm really thinking about long-term plays in this space, and I think that we're still in early innings. Think about right now you have the market, private sector in the U.S. setting up for a change, but in a way we're expecting a strong tailwind to come from the public sector and drive these trades forward. Like anything else, there are going to be winners and losers. There's going to be a lot of money lost as we go through this climate transition, but also a lot of money made. And I think that identifying the good portfolio managers, the good investors who can find and price the right deals will matter as much as it ever has.
Nearly 5 or 10 years ago, ESG investing meant launching a specific ESG fund, and that fund would not have exposure to, for example, oil and gas companies. Whereas today there seems to be a slight shift, which is to say all asset managers are all investing in an ESG lens, and that just means engaging with an oil and gas company, for example, to try and get them to change. Where do you stand on that debate? If someone is professing to be investing with an ESG lens, should they be owning an oil and gas company?
Well, when you first think about it from a fiduciary perspective, when it comes to oil and gas, I think we have to ask serious questions about what's going to be the long-term role of fossil fuels in our economy and society. And there are serious questions there that I think have already been priced in the markets. But you're right, there has been a change in the way that investors are approaching this, which is really wanting to identify the companies that are willing to be a part of the transition, to make the changes that we know need to be made, and to offer those companies long-term capital to invest in being a part of the change, and to really give them engagement, proxy voting support, and other things to move forward. We can't just step away from the changes that we need to make in the real economy. Today, a lot of the game is going to be about active ownership. And it's not just for social or environmental reasons. It's because that's how we're going to unlock the returns that come from the innovation that will power us through this transition.
Shepard Smith here. Thanks for watching CNBC on YouTube.